Hello, gang. Well, it is Sunday night, which is when I talk about Monday morning. And this is Randy Kirk, and I'm glad you're here. And if you're glad you're here, then hit the like button, or you can wait and decide whether I said anything valuable or not and like it later or not. Anyway, but the likes do help. They do help a ton. And I appreciate the fact that so many of you do press the like button. I do need more and more subscribers. That seems to be the category right now where I'm falling a little bit behind. So hit the subscribe button. And of course, I am looking for more Patreon folks. All right, let's get right into what we're talking about on Sunday night about Monday morning. Number one, obviously the market was very excited about the way that the Feds and the U.S. Treasury Department stepped in on the SVB situation. They had existing laws and existing regulations and methods that they could use in order to ensure that 100% of all depositors' money would be covered on Monday morning. This means nobody's going to miss payrolls. Nobody is going to be having problems paying their bills. Lots and lots of folks had very substantial amounts of funds in depository accounts at SVB, including people like Mark Cuban, who was very upset by the entire thing and made it clear how upset he was. So the markets are happy about that. So the pre-market tonight is already showing 1.5% on the NASDAQ up. Unless there's something crazy overnight, we would expect to see that tomorrow morning the market is going to be up, and that typically Tesla in that situation is going to be up about, if the market's up 1.5%, they're going to be up 3.5% compared to the market. Okay, so that's expectation for tomorrow morning. But the big expectation is, because there's an awful lot of people hammering the Fed right now, because this breakdown at SVB was apparently Fed caused. Now, there's some discussion about other shenanigans that might have been going on in terms of, well, I'm not going to get into that because I don't know enough about them. I can't prove them. I'm going to wait for more folks to come out and talk about any shenanigans at SVB. But the appearance is that all they did was cleverly invest their money in long-term bonds at 1.7% months and months ago, a year ago, expecting, there could be some increase in the interest rates, but not the kind of historic increase that the Fed has put us through. And they just couldn't hang in there to wait for these bonds to mature. They had to start selling them at much reduced price. In fact, I think my understanding was a $1.2 billion loss. And this loss was 100% Fed caused. Now, does that mean they couldn't have got out earlier or made some decisions earlier? Of course, there's many things they might have done given perfect hindsight, but nobody, or foresight, but nobody has that, of course. So, but what this means is, and again, lots of folks hammering the Fed, they've raised the rates too fast. Nobody, no manufacturer, no bank, no investors are able to respond quickly enough to this radical increase. Cathie Wood has been saying this for months. Other people have said the same thing. So this could, and is already showing up, that people are now expecting only a 25 basis point raise from the Fed this month, maybe even a pause. Canada has already paused. Believe me, if the Fed gets a little less hawkish, only does a 25 basis point, or even does a complete pause, or maybe talks about a 90-day pause to see where things are, that would just change everything. The market would be like on its way. This is not investment advice. I'm not an investment advisor. What do I know? But the expectation, I think you would agree with me, is the market will go crazy if there's a pause in this interest rate increase situation with the Fed. We did do a couple of videos over the weekend you really need to look at. One about the Cathie Wood report on Friday night. One that was with my new buddy Joe, whose last name I'm never going to remember, Joe Munaretto. Everybody loved that video with him where we talked about the inflation is already under control. Cathie's been saying that for months. Other people have been saying that. Check back and look at that video that we talked about. Inflation is already at 2%. The Fed can stop the nonsense. Cathie says inflation, generally speaking, stays pretty good during periods of high unemployment. Low unemployment. Kathy's been saying this again for months. She says that the theories that the Fed is using are passé, but in fact, they can prove over and over again that the efficiencies get better when you have low unemployment, and as the efficiencies do well, that creates not inflation, but static or deflation. So anyway, lots and lots of stuff to talk about there. You can go back and look at my video about Cathie Wood, or you can go back and look at look at the original stuff where she talks about all this if you'd like to see more. All right, so 10-year bonds, not unexpectedly, because of SVB, there was a flight to safety, and so you saw a dramatic drop in the 10-year bonds down all the way back to 3.7. That is now right around 3.7, even as SVB has been solved. There's still what I would say is a flight to safety, but also an understanding that the inflation rate is in fact under 2% or around 2%. So hopefully the Fed is getting it. The bond rate would not be at 3.7. The 10-year bond would not be at 3.7 if inflation is still over 4. It's just nuts. That just doesn't make any sense at all. All right, so the bond rate, keep watching the bond rate if you really want to know about this stuff. Okay. In general, I'm making a new case. This will be fun. A brand new case that Tesla might be a place where people will want to put their money as a safe haven. What could be better than putting your money into a safe haven? High degree of safety, high degree of likelihood of the money still being there in a year or 2 years, 3 years, like a bond, like a 10-year bond. You're like, okay, I look at this company, Tesla, gosh, I'm pretty sure they're going to be around for a long time, and I'm not going to lose money in the long term. In fact, I'm likely to make way more than the 3.7 with a 10-year bond. I'm likely to make 10% a year or 20% a year being in Tesla. I have a very high reward potential, a very low risk potential. As Stephen Mark Ryan likes to say, the best risk-adjusted investment maybe in the history of the world. So that could, if people start to recognize that in this risk-off environment, that could change the story a lot with regard to Tesla. And you could start to see some of these funds and some of these investment houses start to put more and more money into Tesla as a safe haven, a Costco type investment where it's extremely safe, and yet there's a high potential return downstream. So I have 7 different reasons why Tesla should be looked at as a safe haven. Number one, their cash position. They got over $20 billion in the bank and in cash-like securities. So how many companies have $20 billion in the bank? Number two, their debt position. They have no debt, essentially. They have a little debt, but essentially they have no debt. Number three, their free cash flow is amazing. They're throwing off free cash flow every quarter, and there's no expectation that this won't continue into the future. So this $20 billion, 22, 23, wherever they are right now, is likely to go to 25 and 27 and 30 and then 50 over the next couple of years. Obviously, markets can change, things can change, but that's the likely direction. Again, a very good place to put your capital if you're concerned about risk in other parts of the economy. Number four, they're expanding capacity like crazy. So even as they have this free cash flow, they're building factories all over the world. They're expanding the factories that they have, and they're adding product lines like crazy, like no other company. Find me another company. Go ahead, list it in the comments below. You know I love your comments. Please list it in the comments below. You can tell me any other company that's expanding their product line, anything like Tesla, anything remotely like Tesla at this point. Number five, more dependable income streams. So Tesla has been seen as a car company. 3 years ago, they were looking at as a car company that was losing money, that has potential for the future. Now they're a car company that's making more money than General Motors and Ford combined. But they're still a car company, except now they've got money. They're making all kinds of money on energy storage. They're making money on their supercharger stations. They're making money on insurance. They're making money. They have all these income streams, and some of them are becoming more substantial. So if you have multiple income streams, The semi-truck is another one. We go on. And number 7, a lot of those different income streams are not likely to be affected by a recession. So the energy storage, that is a lot of that is utilities and institutions that buy stuff even during recessions. Semi-trucks are going to be something that people will continue to buy. Only the car division would be affected, and that's number 6. Okay, you go into a recession and you're looking at General Motors or Ford or I don't care who else who has consumables, and you expect their sales to go down in a recession. In Tesla's case, what you'll be looking at as their sales not going up as much. Seriously, think about it. Everybody expects Tesla sales to go up by 50% a year. In a recession, maybe their sales only go up by 25%. Whereas somebody whose sales are expected to go up 10%, their sales go down 10%. So this is another reason for Tesla being a storehouse, someplace you can put your money. And I'm not talking about you. I'm not giving you investment advice. I'm saying that the institutions might go, wait a minute, this is a storehouse. This is a place where we can put cash, where we're really confident that it's not, that the storehouse of money is just going to grow, but that also there's a potential where we can have huge upside rewards if we put our money in this place. All right, last thing for tonight. A couple of people have commented, hey, what do I care about your Monday night and your Friday night, and your Wednesday? What do I care about what's happening in the macro? What do I care about what happens to SVB Bank? I'm a long-term investor in Tesla. I've just put my money in Tesla and I can just sit on it. I can go about my business, watch television, enjoy the golf course, go off to my vacation in Tahiti, and my long-term investment is secure. Tesla's just going to go and go and go. I agree. If you're 35 or 45 and you're just putting the money in and every month you're just adding to it through your 401k, or maybe just you've got a side job and you're putting all that money into Tesla, and you're just trying to build your portfolio, and you don't care what the price is at a given day, you're cost averaging over time, you're probably right. You probably don't care that much about what's happening to the day-to-day things with regard to the economy and with regard to specifics like SVB Bank. However, on the other side of the coin, maybe it is impacting you because let's say you're not already a Teslanaire. Maybe you're not a millionaire. Maybe you don't have millions in the bank. Maybe you've only got 50,000 invested. Maybe you only got 25,000 invested. Maybe you're just barely starting to build your portfolio and you need the income, you need your personal income to continue, or you need your side hustle to continue, or you do want to be a little careful about when you invest in Tesla as opposed to just whatever price, whatever day. So there's lots of different folks out there that have different reasons for following this. Quite frankly, I follow it mostly for fun. I just enjoy it. I always have. I've been following it since I was 17 years old. I love watching the markets, watching how they play out. It obviously affects my businesses. It doesn't affect my other incomes. It affects the price of Tesla. And I play leaps. So since I play leaps, out of the money leaps, way out, a year and a half and out of the money leaps is where I like to play. So as the market goes up and down, I might choose to sell on some given day and rebuy in if I think there's going to be some reduction in Tesla's value. Anyway, everybody's got a different situation. For those of you who like it, who enjoy it, who are interested in watching markets, I'm in your camp. For those of you who it's important so that you can make some buying and selling decisions over time, that's why I do these Monday night efforts. I try to bring you everything that's going on in those efforts. Now, by the way, I said a minute ago that this was the end. It is not the end by a long shot. So I hope you hung in there. There's way more here. I didn't ever talk to you about what's coming up this week, and what's coming up this week is huge. So number one, on Tuesday, we have the CPI report. So consumer price index is coming out on Tuesday. That'll give us our core CPI, our year over year, month over month. We'll get all these reports. The street is thinking it's going to be about the same as last month, about 5% on the CPI, about 4% on the core CPI. Might be better than that. And if it is, the market goes nuts. So it might be better than that. Oil has been flat now for months. That's a big one that I watch. Gold has been flat. Commodities are coming down. We might start to see some flattening, and that could really have a huge impact on the market. Now, if it's higher, obviously the market's going to sell off. No question about that one. Okay, next. On Wednesday, we have the wholesale price index, the producer price index. Same thing, the market. Now, the last month, the producer price index went nuts. If you watched my video the other day with Joe, you saw that. It went crazy for 1 month. Everybody is expecting that to definitely tail off. The producer price index is going to be way more volatile than the consumer price index because producers are buying on the spot market. Producers are, sometimes they're buying it at the very tail end of some kind of a price problem. And then all of a sudden they get it for a much better price, or the reverse. All of a sudden there's just not enough and they just have to buy it, whatever they're buying it at. This would include retailers, wholesalers, even manufacturers are all going to be much more volatile, especially in this kind of an environment where we've had this boom bust situation over the last 3 years. So everybody's expecting the producer price index to be way down compared to last month. I would certainly agree with that. If it isn't, that would be a very bad sign. That would be if the producer price index 2 months in a row is something like 7%, like it was last month. This would be a very bad sign. There may be some stuff in there that is seasonal or not being corrected out. That is something Kathy Wood said. She thinks that might be true. I think Joe agreed that there might be some seasonality or other noise that's not being corrected. But I'm still saying if it's 7% 2 months in a row on the PPI, you're going to see a sell-off in the market. If it's way down, if it's down around 3% or 2% or even negative, that would be a very good sign. Not sure it will move the market very much unless it's seriously negative or there's an adjustment in the prior month. That would be great. Okay, then we have business inventories coming out. Business inventories were up last month a little bit. Everybody's expecting them to be flat. That's not going to move the market very much one way or the other, unless it's just crazy. And if it's really crazy, people are going to blow it off as being a one-time situation. The manufacturing index is also coming this week. That would be the buyers index, what the buyers are, how they're looking forward. Last month, it was down 5.8. That's indicating they think the business is softening and that they're not going to be buying as much in the future. Projection for this month by the street is it's going to be down 7.7. That would be very, the Fed would like that. In general, it's not good for business, but having a couple of 3 months where the buyers are saying, nope, we're slowing down our purchases would be fine as long as that picks back up again. If inventories are not growing, though, at some point, those buyers are going to have to buy more. There's no question about it. I think that is all that's coming up. Housing starts and building permits. Look for flat in that area. I don't see any reason to believe there's going to be any dramatic increase or decrease in housing starts. Industrial production. Yeah, so those are consumer sentiment. That would be something useful to look at. Right now, it's sitting around 67. The street believes it's going to stay about the same. That's very, very low. That means consumers are not excited about the future. 100 is normal, so 67 is very low. I would say that that's probably also not going to be going up. I think consumers are probably very much got their hands in their pockets right now. So expect that to be about around the same area. Okay, now I'm done. And like, subscribe, join Patreon. It's been great talking to you.